Okay, everyone. Good afternoon. And I just want to start off by saying I'm Liz Gagnon, a supervising project manager at the FASB. I want to thank you all for your interest and participation today in our semi-annual CPE Provider Forum. First, we can go on to the next slide. First, I wanted to introduce our presenters today who will be with us throughout the forum to assist with questions. We can go on to the next slide. I will start with Jim Croker. He's our FASB Vice Chairman. And then we have Nellie Debler, who's FASB Deputy Technical Director, and Jeff Mechanic, FASB Assistant Director. So this forum, we can go on to the next slide. The forum is intended to allow CPE providers an opportunity to inquire about final and proposed accounting standards with board members and FASB staff, with the goal of assisting in your preparation of accounting and reporting courses. And as a reminder, the forum is open to standalone CPE providers whose primary business is to provide CPE, as well as individuals who provide CPE within their organization. So for example, a CPA firm or to their organization's clients. The slide presentation will be available for your viewing during the webcast and is also available for download at our FASB website, FASB.org, under the educational webcasts and webinars. We do have a link to it in our chat feature as well, or sorry, our Q&A feature, so you can also grab it there as well. We do encourage you to ask questions during the forum in the Q&A feature, not the chat feature at the bottom of the screen during the presentation. If possible, it would be best if you could try and ask the questions pertaining to a topic as those topics are discussed. We do have some time at the end to answer questions as well. We plan to be flexible with the agenda depending on the number of questions that we've received during the forum. We'll also try our best to answer all the questions. However, we may not be able to get to them all given the time constraints. So if we don't get to them, feel free to reach out to the teams individually or further follow up with additional questions. Views discussed today are based on the individuals that are speaking and not necessarily representative of the views from all the FASB members. So moving on to the agenda, today we'll begin with implementation of major standards and other recently issued ASUs. We'll then have a discussion about the board's current and future technical and research agenda, current projects, and finish with any remaining Q&A. So before we begin, we will be sending out a survey after today's session, as we typically do, to get some additional feedback for future CPE provider forums. We are always looking to have more interactive dialogue between the CPE providers and the FASB board and staff. So if you or someone from your organization would be interested in being an active participant virtually, we'd be happy to have you and know of your interest. We're also interested in hearing about whether you'd like to do any deeper dive on any particular standard or topics that would be of interest to the group and what those topics are. And last, a recording of the webcast will be available online at FASB.org for 6 months. So with that, we can move on to our first topic, which is leases. And now I will turn it over to Jim, who's going to walk us through this topic.
Thanks, Liz, and welcome everyone. We'll talk about implementation and our post-implementation review process on a couple standards. And as Liz said, we'll start with leases, maybe just by way of review or background. The purpose of the PIR is really to gauge whether the standard is accomplishing that which the board set out to do. That is it accomplishing its stated purpose, but also to evaluate the implementation costs, both initial and compliance costs on an ongoing basis relative to the benefits, and also then to provide feedback to improve our overall standard setting process. And that's consistent with respect to each of our PIRs. We, of course, continued that process as it relates to our leasing standard during the year. I would say most of that work was really looking at public company implementation, but then monitoring that practice as it relates to where private companies are at in their process. It's a continuing touch point we have with the private company council. We've also been continuing our efforts to reach out to preparers and practitioners, both those who have served clients who have already adopted or where the practitioner has adopted, as well as preparers and practitioners who are in that process. Also touching base with the IASB as their standard is very similar to ours. Obviously, if you've gone through those in your previous CPE, you know that the differences, but fundamentally core principles, definition, and other things are really similar. So reaching out to the IASB, as well as looking at public company filings, including through the use of XBRL, all of which is helping us, one, monitor sort of implementation, what did that look like, but that outreach also helps us identify issues where there were perhaps unintended consequence. You've seen that in a number of updates that we've already done to the standard, and I'll talk about an important one that we really identified through our work with the private company council and the impact that the lease standard was having as it related to implementation associated with leases to related parties under common control. Maybe just one final thing on this slide, that this really will feed into our entire PIR effort. One of the things that we'll certainly continue to do in that process is user outreach in terms of the decision usefulness of the changes to lease accounting, ultimately leading to a post-implementation review report. But we really do view it as an iterative process, not waiting to the end to take action, but as we identify issues, go ahead and address those issues on a timely basis, which really does lead me to the next slide and our discussion with the private company council on the impact that they were seeing associated with common control lease arrangements. Now you may recall that under the old standard or 840, common control leases or related party leases, and particularly common control leases, were accounted for pursuant to their economic substance. And working with the PCC at the outset of the standard really identified some potential challenges with trying to determine economic substance, particularly as it relates to the pricing between related parties under common control. How do you determine the economic substance of a variable lease payment or a variable rental agreement with a common control party where the payments might be based upon available income? Seems in a non-related party transaction, you might not see similar terms, and really advice that we ought to follow the stated terms of the lease, really no different from any other lease arrangement. What we saw though in implementation is obviously that the standard talks about the legally enforceable terms, and that was posing a challenge in related party common control lease arrangements, both for those arrangements that didn't have written terms, but even perhaps surprisingly to me, even in those arrangements where there were stated or written terms, of whether or not the board had envisioned private companies needing to go hire legal counsel or involve other third parties to determine what the legally enforceable terms in those arrangements were. I don't, having been on the board at the time, I don't think it was something I would have had envisioned if you had a written lease agreement between those parties needing to go hire third party counsel to determine the legally enforceable terms. But I certainly can understand, in the situation where you've got a common parent, and sometimes terms, for example, renewal options might happen on an implicit basis. Are those inside or outside the legally enforceable terms, and why that might be a challenge? That also led to the identification by a number in the private company space of the follow-on effects of the amortization guidance for leasehold improvements, which says under 842, not dissimilar, slight differences, but in principle, not dissimilar from 840, of amortizing leasehold improvements over the lease term. And so if you thought about an agreement between related parties under common control where there wasn't a stated or implicit renewal option, and so you maybe have a month-to-month or year-to-year lease, but developed significant leasehold improvements, did it make sense economically to amortize those over a shorter period of time? So in any case, the board took on a project to address both of those issues. First, to provide a practical expedient for private companies to rely on, for those arrangements that do have written terms, to treat the written terms as being the equivalent to the legally enforceable terms. That is, not having to go through a broader analysis of those arrangements for which the terms are written. And that is proposed as a practical expedient for those arrangements for which there are no written terms. You still have to go through an 842 analysis to identify, do I have a lease and what are the terms? But certainly those that are in writing, that expedient would allow you to look at the written terms as being the akin to or the equivalent of the legally enforceable terms. So that's really the first piece of the expedient. If the I'm sorry, the other point on that slide is that the expedient can be applied on a lease by lease or a transaction by transaction agreement, and that expedient would be available to private companies, those non-public entities, not-for-profit bond obligors, employee benefit plans who file with the commission would continue to follow the public company. That is, the scope follows sort of the private-public distinction. So we turn to the second issue, that is on leasehold improvements itself. So I mentioned this is really the second area particularly for related parties under common control, where the guidance on the amortization of leasehold improvements that applies more generally under lease accounting, that would say you don't amortize the leasehold improvement beyond the lease term, including consideration of renewal options that then become a portion of that lease term, probably made more sense in the context of arrangements where you don't have common control. That is, if you don't have the ability to control the lease asset beyond the lease term, that is, there's no renewal options and the lease term, let's say, is a year, that amortizing those leasehold improvements over a longer period of time when you don't have a related party under common control didn't seem to meet the definition of really an appropriate amortization period. That is, I can't control the benefit of the asset beyond the lease term, and so I ought to recognize as amortization the consumption of that asset over that period of time. In debating that initially, I don't think the board really had in mind arrangements where the counterparty is under common control. That is, an amortization period that follows the life of the asset, the common control or the other party's life of the asset. Economically, probably made more sense, at least to the majority of the board. That is, you would amortize the asset or the leasehold improvements over the life of the related lease asset. Of course, if the counterparty was a common control party that was leasing in the asset, your life wouldn't exceed that period. And the conclusion was really premised on the fact that if the arrangement isn't renewed and the lessee ends up reverting the asset back to the related party under common control, it's really a transfer of the leasehold improvements to that common control party at that point in time. So that's really an overview of the conclusions of the board. I know we had a question already about when could we expect the exposure draft. Nellie, if I get this wrong, just correct me. I think it's in the fatal flaw review process right now with outside stakeholders. Will go to the board for our balloting process shortly after that, and we could expect something probably later, mid to late November. Does that sound somewhere in that time? We're not committing to a
That's our
date,
plan.
but I would say it's not an unreasonable time period to probably expect it. And we're certainly aware of the importance of getting this out and addressed, given the quickly approaching adoption date for private companies. We do have a 45-day comment period. I do think that the board can relatively narrow scope in terms of what we're covering. So I think subsequent to that, hopefully the board can quickly readdress and get this finalized. So that's what I have on the lease implementation. If there aren't any additional questions, Jeff, I think, do I turn it to you?
You indeed do, Jim, and it's great to be here with everyone today. Welcome. So I'm going to cover one of the other areas that we have a post-implementation review going on, and that is credit losses, or CECL, the current expected credit losses model. As a reminder, the PIR for the credit losses standard began back in 2020 with the first wave of implementers who were SEC filers, and the PIR remains ongoing. Staff activities have included outreach to stakeholders directly, monitoring publicly available financial information from that first wave, stakeholder surveys, and a public roundtable that was held back in May of 2021. Feedback resulted in 2 projects being added to the board's technical agenda in July of 2021. The first project was related to troubled debt restructurings, or TDRs, as well as vintage table disclosures. And that project culminated in ASU 2022-02, which was issued back in March of this year. The second project relates to the accounting for acquired financial assets, and that remains ongoing. The staff has also been performing pre-implementation monitoring for non-public entities, which includes all private companies and all not-for-profit organizations. There's no public-private split for not-for-profits with regard to this standard. Anyway, all non-public entities that are adopting CECL in 2023. And then after that, we'll resume our additional post-implementation review activities after adoption. Let's move on to the next slide. As part of the board's effort to educate stakeholders, the staff prepared 2 documents back in 2019 that discuss frequently asked implementation questions, FAQs. I just wanted to make sure that you're aware of them, and we've provided links to those 2 Q&As on this slide. These links take you to the FASB's implementation webpage for the credit losses standard. So again, that's where you can actually find these Q&As. The first Q&A, the one up top here, discusses the weighted average remaining maturity, or WARM method, for measuring estimated credit losses, which was already being used by many financial institutions. The Q&A discusses considerations for how WARM can be an acceptable method for estimating expected credit losses. The second Q&A, meanwhile, responds to other implementation questions received on the various requirements of CECL, including those around developing reasonable and supportable forecasts, which is a key aspect of the CECL model. And as a reminder, CECL isn't just about loans. Trade receivables, for example, are squarely within its scope. Let's move on to the next slide. And that is ASU 2022-02 on TDRs and vintage disclosures. Move on to the next slide here. As mentioned, following the May 2021 public roundtable, the board added a project to its agenda to address TDRs and vintage disclosures. The board issued ASU 2022, as I said already, back in March. That ASU removed the unique TDR recognition and measurement guidance for entities that have adopted CECL, and instead, oh, sorry, somebody is, okay. That ASU removed the unique TDR recognition and measurement guidance for entities that have adopted CECL, and instead requires enhanced loan modification disclosures for such creditors. It also enhances the vintage disclosures that are only required of public business entities. Let's move on to the next slide. Why did the board get rid of TDR accounting? Well, the board received feedback that with CECL, a specialized TDR model, above and beyond applying the modification guidance that exists for all loans, was no longer necessary. The modification guidance, as you know, involves determining whether the accounting for a loan should continue or whether that loan has been extinguished and a new loan should be accounted for. And the board also heard that the voluntary disclosures about modifications that were being provided in 2020 in response to COVID-19 were an improvement to the existing modification disclosures. Thus, TDR accounting about borrowers experiencing financial difficulty to whom the creditor makes financial concessions was removed in favor of enhanced disclosures about modifications made to borrowers expecting financial difficulty. The modifications for which disclosures are required include things such as principal forgiveness, interest rate reductions, and other than significant payment delay or a term extension. As for the vintage disclosures, the original ASU only required PBEs to present the amortized cost basis of their loans by credit quality indicator and by year of origination. However, one of the illustrative examples in ASU 2016-13 included additional information about gross write-offs and recoveries. What we heard from investors was that gross write-off information by year of origination was especially important to them in their analyses. Thus, ASU 2022-02 makes that an explicit requirement within the vintage tables, again, only for PBEs. Let's move on to the next slide, and then on to the next one after that. And that's our current project on acquired financial assets. The other project added in July 2021, as I mentioned before, is still ongoing. It was added because stakeholders indicated that having two models, one for purchased with credit deterioration or PCD assets, and another for purchased without credit deterioration or non-PCD assets, was confusing. In this project, the deliberations for which began back in February, the board has decided to amend the term purchased with credit deterioration or PCD to purchased financial assets for referencing the financial asset acquisition model that it's seeking to expand to all acquired financial assets with limited exceptions, irrespective of change in the credit quality of the assets since origination by the acquiree. The board recently decided that a seasoning element should be incorporated to prevent an acquirer's originated assets from being accounted for under this model. The board also decided that seasoning should be defined under using a principles-based criterion that considers the acquirer's involvement with the asset prior to acquisition. Now, that criterion has a bright line period of 90 days, and financial assets acquired in a business combination should be presumed seasoned. The board also made decisions to include credit cards, home equity lines of credit, trade accounts receivable, and assets not recognized at fair value in a business combination in the scope of the model. Initial deliberations are continuing, so stay tuned. With that, let me see if we have any questions before I pass this on to Liz.
Doesn't look like we do, Jeff.
Okay. If not, Liz is going to tell us all about government assistance.
All right, great. Thanks, Jeff. Okay, so we can go to the next slide. So there's no explicit guidance and gap for business entities to recognize and measure the receipt of government grants. And so business entities typically analogize to International Accounting Standards 20 or IS-20 on the accounting for government grants, or the contribution model in the not-for-profit revenue recognition guidance, which is in subtopic 958-605 to account for these transactions. So last November, the board issued ASU 2021-10 on disclosures by business entities about government assistance. And as the name indicates, business entities are included in the scope of these amendments, and more specifically, the disclosures apply to business entities that account for a transaction with a government by applying a grant or contribution accounting model by analogy, such as subtopic 958-605 or IS-20. The required disclosures are intended to provide more comparable and transparent information to investors and other financial statement users to enable them to understand an entity's financial statement results and the prospects for future cash flows. The amendments are effective, or they were effective for financial statements issued for annual periods beginning after December 15, 2021. So we can move on to the next slide. So for the entities that are in the scope of the ASU, they are required to disclose information about the nature of the transactions and the accounting policy used to account for those transactions, the line items and the amounts on the balance sheet and income statement affected by the transaction, and also the significant terms and conditions of the transactions. Moving on to the next slide. So this slide talks about the research project, and as part of the the board's 2021 agenda consultation, the board had asked stakeholders whether it should pursue a project on the recognition and measurement of government grants. And if so, should the board leverage an existing grant or contribution model, such as the model in IS-20 or subtopic 958-605, or develop a new model? Feedback varied among the stakeholders. Some stakeholders observed that the lack of specific guidance on the recognition and measurement of government grants has created diversity in practice, and suggested that the board provide accounting guidance for government grants to ensure comparability between companies and across industries. To overcome the challenges on defining which types of government grants would be included in the scope of a potential guidance, some stakeholders have suggested that the board provide recognition, measurement, and presentation guidance for just a specific subset of transactions that are widely understood as government grants, such as cash grants. They noted that addressing the recognition, measurement, and presentation for a specific subset of government grants might be a first step and represent an incremental improvement. And so in December of 2021, the FASB chair added a research project on the accounting for government grants, which was in response to the 2021 ITC feedback about the lack of authoritative guidance. And then in June of this year, the FASB issued, or the staff issued, an invitation to comment on the accounting for government grants by business entities to solicit feedback on whether the recognition, measurement, and presentation requirements in IS-20 should be incorporated into US GAAP. The comment period ended in September of this year, and we're currently, right now, the staff is working through the comments received and performing some additional outreach with investors because we didn't get a lot of comment letters back from them. The purpose of the ITC was for the FASB staff to understand whether the requirements, including the scope and the definition of the terms government and government grants, are understandable and operable in the US financial reporting environment. Also, that the requirements improve comparability in the accounting for government grants by business entities that apply GAAP. We also wanted to understand any suggested changes that should be made to IS-20. Also, whether the requirements provide decision useful information to financial statement users. And last, any current practice issues that arise when applying the government grant accounting requirements in IS-20. So before I move on to the next topic, I'm just going to see. Okay, so we did get one question. And the question is asking, why were the requirements, well, the requirements, I guess it's asking about whether business entities should follow 958-605 versus IS-20. And so the requirements, I guess I'll first start with the disclosures. The disclosures that went out, they didn't actually change any of the rules that people are doing. It just added some disclosure requirements for business entities that are applying, by analogy, a grant or contribution model. So that would be if somebody is following 958-605 on the contributions or IS-20 to account for their government grants, then they would have to do the disclosures. Now, in terms of the recognition and measurement, first of all, this is a research project right now, so it's really just the staff gathering information. There has been no changes to GAAP around what the requirements would be. So companies would continue to do what they're doing today, and they would analogize to a contribution or grant model as they're doing today. But the board, part of what they're looking at, or part of what the staff is looking at in this research project, is to understand IS-20, which is used, from what we've heard, more broadly than, at least in the public company space. More companies analogize to IS-20 to account for government grants than they do to subtopic 958-605. But I think as the board looks at the feedback from the invitation to comment on IS-20, and if it is a workable solution, part of some of the comments we got also suggested considering certain aspects of subtopic 958-605. And so I think all of that will be part of the consideration when the board thinks about whether they want to add a project and what the project scope would that be. So to answer the question, there is no additional requirements right now, and it's still undecided about what requirements would be if the board took on a project to address the recognition, measurement, and presentation of government grants. So it looks like that's the only question we got on this topic. So I think we can go on and move to the next topic. Okay, so the next topic, we have talked about this before in other CPE provider forums, but we thought it was important to just reiterate some of the main points. We can go on to the next slide. So we issued Issue 2020-07 with the objective of increasing the transparency about contributed non-financial assets, which most people refer to as gifts in kind, through enhancements to presentation and disclosure of an organization's financial statements. While we have talked about this issue on the webcast in the past, you know, we wanted to give you a reminder of the effective date as well, because that's been recent. So the scope of the guidance includes contributions of non-financial assets. And as I mentioned before, we do use this term interchangeably with gifts in kinds. But it is important to note that while gifts in kinds can be broadly defined as including all non-cash gifts, financial assets such as stocks, bonds are excluded from the scope of the guidance. We can go on to the next slide. So as an overview, a non-for-profit will be required to present contributed non-financial assets as a separate line item in their statement of activities. This presentation will be supplemented with additional disclosures of a disaggregation by category of non-financial asset. So for each category, an organization will also disclose the dollar amount as well as information about how the assets were used or monetized, including any associated donor restrictions and the valuation techniques used. The ASU's requirement will help ensure consistency across the sector wherever gifts in kind are significant. We can go on to the next slide. The effective date and transition are included on this slide, and the amendments were effective for annual periods beginning after June 15, 2021, and interim periods beginning after June 15, 2022. Early adoption is permitted, and retrospective transition is required for all periods presented. So we did get one question. Volunteer hours. So this question, we got a question around whether the disclosures, this requires a disclosure on volunteer hours that do not meet the criteria to be recognized as contributed services. So this question, I believe, is getting at, there are some disclosure requirements on contributed services that are not recognized. So those would be a separate disclosure from what these would require.
Those are existing disclosures.
Yes, those are existing disclosures that were already there. So we did not, as part of this project, we did not include those disclosures. So you would have to look to those disclosures for anything where you don't recognize the contributed services. Okay, I think that's no other questions on that. So we can move on to the next topic. So this is fair value measurement. This talks about ASU 2022-03, which was issued in June of 2022, and it clarifies the guidance in topic 820 on fair value measurement of an equity security that is subject to contractual sale restriction. And it also requires specific disclosures related to such an equity security. There is also an illustrative example in topic 820 that has resulted in diversity in practice of whether contractual sale restrictions to be considered in the measurement of the fair value of the equity securities that are subject to contractual sale restrictions. Some stakeholders indicated that they use a discount for contractual sale restrictions when measuring the fair value, while others viewed the discount to be inconsistent with the principles of topic 820. And so this ASU clarifies the guidance and also amends the illustrative example in the guidance in paragraph 820.10.55.52, which is example 6 of case A. The amendments clarify that a contractual restriction on the sale of an equity security is not considered part of the unit of account of the equity security and therefore is not considered in measuring the fair value. The amendments also clarify that an entity cannot, as a separate unit of account, recognize and measure a contractual sale restriction. The amendments do not change the principles of fair value measurement. They clarify those principles when measuring the fair value of an equity security subject to a contractual sale restriction and improve current GAAP by reducing diversity in practice reducing the cost and complexity in measuring fair value, and increasing comparability of financial information across reporting entities that hold these investments. So moving on to the disclosure slide, the next one. The amendments, as I mentioned, they also require entities with investments in equity securities subject to contractual sale restrictions to disclose certain qualitative and quantitative information about those securities, including the fair value of the equity securities subject to contractual sale restrictions reflected in the balance sheet, the nature and remaining duration of the restrictions, and the circumstances that could cause a lapse in the restriction. So moving on, transition and effective date. So the amendments are effective for public business entities for fiscal years beginning after December 15th, 2023, and interim periods within those fiscal years. For all other entities for fiscal years beginning after December 15th, 2024, and interim periods within those fiscal years, and early adoption is permitted. They should apply the amendments prospectively, and any adjustments from the amendments should be recognized in earnings and disclosed on the date of adoption. For investment companies that are under topic 946, they would apply. They would only apply to an investment in equity security in which the contractual arrangement that restricts its sale is executed or modified on or after the adoption date. So let me just see if we get any questions here. Sorry, I just lost my thing. What is an example of a sale restriction on entity securities? So Nellie or Jim, you may have, you may want to jump in here, but so essentially what that's saying is if you have an equity security in which there are restrictions on the sale, in other words, you can't sell, you have to go and get permission to sell the security, or there are certain things you'd have to do in order to sell. You can't just go on an open market and actively sell a security. So that's what we mean in this issue in terms of something that is a restriction on a sale of an equity security.
So yeah, that's right, Liz. I think it comes up. This initially was raised in the context of underwriter restrictions, where in connection with a company going public, there might be classes of equity that either insiders or others that participated prior to the IPO agreed to contractually restrict themselves from selling their securities for a period of time. And so the question was, what is the impact of those contractual sales restrictions on the underlying determination of fair value? I think originally the board had thought about a more narrow scope that was just underwriter restrictions. Through the deliberative process, really broadened that out to any contractual sale restriction that for a period of time bars the holder of the security from selling when others that hold that class of security don't have the similar restriction on their shares. I think it's not uncommon in SPAC transactions, for example, to have people who participated in the transaction prior to an initial public offering or de-SPAC to have their securities restricted from sale for a period of time.
Okay, thanks, Jim. Okay, so moving on to the next topic. To clarify for public companies, this standard can't be early adopted. So the standard does have early adoption to be permitted. I believe that's for all entities. Nellie, can you correct me if I'm wrong on that one?
I think that's right.
I didn't think that was just for private non-publics. I think that's for everybody. So, okay, so moving on to the next topic here. All right, so the next one is Issue 2201. So in March of this year, the board issued Issue 2201, which clarifies the guidance in topic 815 on fair value hedge accounting of interest rate risk for portfolios of financial assets. The ASU amends the guidance that was in ASU 2017-12, which was released in August of 2017, that, among other things, established the last of layer method for making the fair value hedge accounting for these portfolios more accessible. So ASU 2022-01 renames that method the portfolio layer method and addresses the feedback from stakeholders regarding its application. And so there were a number of questions that were raised by stakeholders. I'm not going to go through them all here. A lot of them are included in the ASU if you go back and read it. But essentially, the guidance in this ASU addresses those questions by expanding the current layer of last of layer method that permits only one hedge layer to allow multiple hedged layers of a single closed portfolio. To reflect that expansion, the last of layer method is renamed to portfolio layer method. Also, it expanding the scope of the portfolio layer method to include non-prepayable financial assets. It also specifying that eligible hedge instruments in a single layer hedge may include spot starting or forward starting constant notional swaps, or spot or forward starting amortizing notional swaps, and that the number of hedge layers, that is single or multiple, corresponds with the number of hedges designated. It also providing additional guidance on the accounting for and disclosure of hedge basis adjustments that are applicable to the portfolio layer method, whether a single hedge layer or multiple hedge layers are designated. And last, it's specifying how hedge basis adjustments should be considered when determining credit losses for the assets included in the closed portfolio. And moving on for the effective dates, these are for public entities, for business, for fiscal years beginning after December 15th, 2022, and interim periods within those fiscal years. And for all other entities, it's for fiscal years beginning after December 15th, 2023, and interim periods within those fiscal years. The guidance may be early adopted if an entity has adopted ASU 2017-12 for the corresponding period. I don't see any questions for this topic, so I think I can move. I think, Jeff, you're covering the next topic for us.
Yeah.
So I'll turn it over to you.
Thanks, Liz. I'm not only covering the next topic, I'm covering the next several topics. Anyway, the first couple of things that I'm going to talk about are two ASUs that we issued late last year, which I believe we covered in the March webcast, but this will give you some additional opportunity to ask questions on those couple of ASUs. Then I'm going to talk about an ASU that we just issued on disclosure of supplier finance program obligations at the end of September. So it's almost like hot off the press. All right, so on ASU 2021-07, which we issued last October, let's move on to the next slide. It involves stock compensation. It's an area within stock compensation, and stock comp is a topic that the PCC has been seemingly looking at on and off for much of the decade that it's been in existence. Indeed, the PCC's work had helped spur the board to make some targeted improvements to employee stock compensation accounting with ASU 2016-09, as well as some simplifications that the board made to non-employee stock compensation when the board largely aligned that with the accounting for employee stock compensation via ASU 2018-07. As a result, there have been expedients available to private companies and sometimes to others as well for pretty much all of the inputs into an option pricing model, except for one of those inputs, the sort of holy grail here, and that is some sort of expedient for what is arguably the most difficult input particularly for a private company as opposed to a public company into an option pricing model, and that is the current price of the underlying share in these option awards. Again, pretty difficult in many cases for private companies, at least relative to public companies. Let's move on to the next slide. So ASU 2021-07, as a reminder, these are the key provisions of it. First, there is an expedient. This allows an expedient for private companies, non-public entities only, to use a value determined by a reasonable application of a reasonable valuation method. I'm going to come back to those words in a little bit. As the current price of its underlying share for purposes of determining the fair value of an equity classified award in topic 718 at a grant date or upon a modification. It's important to note that that this would be applied, this expedient, on a measurement date by measurement date basis. So if you apply it, you must apply it to all awards involving a stock as of that date, as an underlying stock as of that date. And this would apply to awards that are issued both to employees and to non-employees, such as vendors and so forth. It would only apply to equity classified awards, and those, remember, those are the ones that are not being revalued every period, unlike liability classified awards. If you do use this expedient, you do need to disclose that you've used this expedient. Transition would be prospective, so for all awards after the issuance of this ASU. And the effective date would be, is for fiscal years beginning after December 15th, 2021. So for calendar year 2022, we're in that year that it could be applied. Interim years 1 year later for those relatively few private companies that do interim GAAP financial statements, and early application is permitted. Let's move on to the next slide. Let me come back to those that term, reasonable valuation method. And we use those words very deliberately because those are the words that are used in the U.S. Treasury regulations for Internal Revenue Code Section 409A, or at least those are the word, or Section 409 as it existed as of the issuance date of the standard back in October of 2021. And so the valuation that is performed using the types of factors that are on the top part of this slide, and there's more. If you look at the amendments that this ASU put into place, a little bit more detail on that there as well. Then that would get you to this practical expedient. And what we make a statement, I believe, was in the basis for conclusion, that evaluation performed in accordance with the Treasury regulations is one way to achieve this practical expedient. So what we're really trying to do there, let's move on to the next slide. What we were trying to do was to help private companies without ambiguity kind of do what they were already doing, which was leveraging off of valuations for tax purposes. And so this slide here has some of the expected benefits that the PCC had in mind in doing with this expedient. But in some, I'd say that at the very least, what we did was codify what was existing practice, again, leveraging off of valuations for tax purposes. And to the extent that that's helped make preparation and audit of financial statements at least a little more efficient, I mean, in my view, at least, that's a very good thing. Let's move on to our next ASU, which is another one that we issued late last year, this one in November, and that is ASU 2021-08 on recognition and measurement of revenue contracts with customers under topic 808. So it's acquired revenue contracts. Let's move on to the next slide. So ASU 2021-08 involves the recognition and measurement of revenue contracts with customers acquired in a business combination, hence under topic 805. This project arose to address diversity in practice after adoption of the revised revenue recognition guidance, that is topic 606. The definition of a performance obligation in that standard did not align with the general practice of accounting for deferred revenue in a business combination, which analogized to certain guidance and recognized deferred revenue only if it represented a legal obligation of the acquiring entity. Now, investors told us that revenue was an area where it is particularly important for them to understand trends over time. As such, investors had been spending a lot of time trying to understand the accounting for revenue contracts obtained in acquisitions, and preparers had been spending a lot of time explaining that accounting. So what ASU 2021-08 does is it requires an entity to account for acquired contract assets and contract liabilities in accordance with topic 606, plain and simple. This means that the revenue recognition for acquired contracts will be more similar to originated contracts, as the same principles are going to be applied. In addition, this new guidance seeks to eliminate differences in the amount of post-transaction revenue recognized based on the timing of payment. That's another place where there had been diversity in practice. In order to make this assessment to do the accounting under topic 606, the acquirer may be able to leverage the accounting done by the acquiree. That is, if it's well documented, correct, well-supported accounting, then the acquirer may be able to record the contract assets and contract liabilities at the amount that the acquiree had recorded in its financial statements. However, it's important to note that the responsibility rests with the acquirer to review the accounting and make the assessment as to the application of topic 606. I think it's also important to note that we're just talking about contract assets and contract liabilities, not any contractual or non-contractual customer-related intangibles that might arise in a business combination, including those that arise from the terms of an agreement being more or less favorable than typical market terms. The ASU is required to be applied by public companies, remember the public non-public split in the RevRec standard, for fiscal years beginning on or after December 15, 2022, or in other words, for calendar year 2023, and 1 year later for non-publics, and early adoption is permitted here. Let me move on to the, actually, let me stop since I've covered 2 ASUs. I just want to see if there are any questions. Again, these are ones that we've previously talked about, but just want to see if there are any questions. Okay, nothing yet, right, Liz?
That's right, Jeff.
All right, so let me move on to that hot off the presses ASU, ASU 2022-04, which we issued right on or about September 30th. It was within a day or two of that, so just at the very end of the third quarter. Let's move on to the next slide here. So this area is often called reverse factoring, and I'll get to that when I walk you through an example of this in a minute. But what we're trying to do here is we're trying to bring some more transparency for customers, for those who are buying supplies from vendors, buying product, services, whatever from vendors, and essentially because of these arrangements have extended payment terms, a type of financing, which might not otherwise be apparent. So what are we talking about here when we talk about supplier finance programs, which are often also called, as I said, reverse factoring, called supply chain financing, all sorts of different things. I think the schematic on the next slide, and I'll walk you through this, I think tells a lot, and it really talks about, it leads us to talking about, what are the incentives here? Why do these things exist? So walking you through the slide, it's 3 parties to this arrangement. You have a customer. In this case, the customer is the reporting entity. These disclosures that I'll get to on the following slides are for the reporting entity here. The customer has a supplier of some sort, a vendor, and there's also a third party involved here, a finance provider, which is typically a financial institution, a bank, and so forth. So what typically happens when this type of an arrangement? Well, here's the sequence. A customer enters into an arrangement with a supplier and places an order. That's the first thing that happens. Secondly, the customer receives an invoice with payment details after the supplies have been delivered, et cetera. Then third, the customer approves the invoice and provides related payment instructions to the finance provider. Then fourth, the finance provider makes available to the supplier the option to elect for early payment at a discounted value. Then fifth, if the supplier elects early payment, the finance provider pays the supplier the discounted value, which is the invoice amount less early payment fee, to the finance provider. You can see why this is called reverse factoring. It's essentially the same kind of thing as if the supplier had factored its receivables, but coming from a different direction. We'll explain the reason for that or the benefit of that in a minute. Anyway, if the supplier does not elect early payment, on the other hand, then the finance provider will pay the full amount of the invoice at the due date as opposed to early. And then finally, on the due date of the invoice, the customer pays, the reporting entity here, pays the finance provider the total value of the invoice. So this is what's happening here. Let's move on to the next slide. So what are the incentives? Why is this here? Well, what you have as a benefit for the customer is you have some extended payment terms sometimes. You definitely have, and this is probably the key benefit, you help promote a stronger supply chain, because what this gives to the supplier is additional liquidity and, very importantly, more favorable terms versus traditional factoring of the receivables by that supplier. Why? Because often what you'll see here is that the customer is typically a larger company, often but not always a public company, and the suppliers, at least in many cases, are smaller companies that are often, though certainly not always, private companies. So what you essentially have here is financing using the larger company's credit standing rather than the smaller company's credit standing, and therefore more favorable terms, as well as, of course, liquidity going to the supplier. And of course, the finance provider gets interest income. And these types of arrangements probably have some more transparency into the creditworthiness of the underlying receivables versus the traditional factoring, because of the availability of information on the customer. Let's move on to the next slide. Now that you kind of know what these things are, some of you may have already known well, a lot about them. What's in the ASU? Well, the ASU, the scope of it, the scope of the transactions that are involved, the arrangements that are involved, are listed here, and it's pretty much the types of things that I just highlighted in that schematic. The disclosures that are involved here are key terms of the program, including but not limited to the payment terms, including payment timing and basis for that determination, assets pledged to security or other forms of guarantees committed for payment to the provider or intermediary, as well as the amount of obligations outstanding at the end of the reporting period, and balance sheet presentation of the obligations and roll forward of those obligations. Roll forward, as you'll see in a minute, there's some more implementation time for that piece of it. And there's also some interim reporting information as well. Again, what we're trying to do here is bring more transparency to investors and other users of the financial statements, that these types of arrangements might not otherwise have been apparent do exist, and the entity is engaged in them. Okay. Transition and effective dates. Let's go on to the next slide. This would be this is implemented or is to be implemented retrospectively. So you have to have these disclosures for any comparative year presented. Early adoption is permitted. All amendments are effective for calendar year 2023, years beginning after December 15, 2022, interim periods within those years. And the roll forward information mentioned on the last slide is effective 1 year later. Let me just see if you have any questions on this particular ASU before I move on to one final topic in this area of this section of the forum. Okay, what do we got? Is the intention to have public entities present the roll forward table during interim periods the following year? I have to say, I don't offhand remember that. I don't know, Jim, if you remember it. Oh, somebody said no. Okay, thank you, Sarah. Okay, so when my teammates help me out here, so the answer is no. Okay, any other questions on this? All right, awesome. All right, let's move on to our last topic. It's really not a standard by the FASB, but one. I mean, I've spent a bit of time on these last few forums with you, talking about the federal COVID assistance programs and some of the accounting for it and so on. Really, as I said, over the past few forums. And here is where I'm going to really turn to the disclaimer that Liz gave early on, that I'm speaking for myself. These are not views of the FASB board or official positions of the FASB. Again, these are my best thoughts here. So this is an area where we've continued to get questions of all the federal assistance programs. The one that we continue to really get questions, a lot of questions about, and I know the AICPA gets lots of questions on their hotline, are employee retention credits. And those questions, which we've even talked about at PCC meetings and NAC meetings and so forth, NAC being the Not-for-Profit Advisory Committee, include things, let's go on to the next slides, as basic as, are these income tax credits? And the answer is no. These are payroll tax credits. These don't depend on taxable income. They depend on payroll tax, or having employees who'd be paying payroll tax on their behalf. And what I've said in various webcasts and speeches and so forth, and the AICPA put out an article, published an article in the Journal of Accountancy a few months ago, which also gets to this, is that a conditional grant model would seem to be appropriate for these types of credits. Again, they're not income tax credits. And remember that if it's a not-for-profit that's receiving these, then that has to be, because there's direct guidance that scopes them in here, subtopic 958-605, the contribution model that we enhanced a few years ago through ASU 2018-08. On the other hand, businesses, for-profit entities that receive these, that grant model would be either subtopic 958-605 by analogy. Again, they're not directly, they're specifically scoped out, or IAS 20, and Liz talked a bit about analogizing earlier. But again, those would be your two models. It's important to note that, and this is where we get also questions about, can you net these grants, these credits directly against your expenses that are being reimbursed in your financial reporting, in your GAAP financial statements? The answer is yes, only if you're analogizing to IAS 20 as a business enterprise. If you're applying 958-605 by analogy, as with many other areas in GAAP, netting would not be permitted. And as I think it said gotten up on my soapbox and said before, at least with regard to a not-for-profit where expense information is really important in terms of what it takes to run an organization, and then how do you fund it, disrupting that type of expense trends, those types of expense trends by netting down, probably you're not doing a good service to many of the readers of your financial statements. So I'd argue it's not better financial reporting to net down, at least for a not-for-profit. Liz mentioned the disclosures in ASU 2021-10. I think here, as with many of the other assistance programs, it's particularly important to have those good disclosures. Now, I said that this conditional grant model would seem to be really the appropriate model. And I would make the argument that even in the situations that we were seeing back in 2021, remember back in 2021, a lot of companies were learning for the first time that they could indeed qualify both for employee retention credits as well as the Paycheck Protection Program. There was initially some confusion about that, and the December 2020 Congressional Reconciliation Act did clarify that you can do so as long as you're not, at least in my words, or to use my words, double dipping, claiming the same expenses for both the PPP and the employee retention credits. Now, a couple of months after that, in February of 2021, the AICPA's Center for Plain English Accounting published an article which indicated that in those type of situations where you already had closed your books and issued your financial statements for, say, 2020 in that case, and you're trying to report, now in 2021 without having to, restate your financials for 2020, they indicated that a loss recovery model, in their words, would be a reasonable, type of model. I would say, at least again, my point of view here, that I'm not sure you would have to go to a loss recovery model. At least in the not-for-profit sector, sometimes we do get grants or the sector gets grants that are to reimburse for expenses that were already incurred, sometimes incurred a little while back. And in those particular case, a grant model or applying the contribution model would be perfectly appropriate, but you would just you'd be able to recognize it immediately because you'd already met all the conditions, you already incurred the qualifying expenses. Don't see why that wouldn't have been at least a reasonable approach here as an alternative to a loss recovery model. And indeed, in the Journal of Accountancy article that the AICPA published, they indicated that there are different potential approaches here. So I'll just throw that out to you. But in any case, that's another reason why the disclosures in ASU 2021, having some good transparency about how you've accounted for all this stuff and so on, and the terms and conditions is really important. So with that, let me see if we have questions. Oh, actually, I do want to say one more thing here, and then I'll see what questions we have. I will say where I continue to get questions, I know the AICPA continues to get questions, is about the actual timing of recognition of whatever model that you're using. And I have heard that there's diversity in practice. Some would recognize the revenue here or net down the expense, I guess, when they incur the cost, when the company incurs the cost. Some would do it when they amend the 941 have taken that formal action, and some would wait until they're actually notified this of the award of the employee retention credits. It's important to note here that unlike the Paycheck Protection Program, they haven't entered into an agreement and they're just waiting for forgiveness of a loan that's been taken out. Here, one could argue that there is no agreement here. This is not an entitlement. And therefore, one could argue that you can't meet conditions until you actually have an award. And then there's some difference of opinion here, difference of views as to when you have an award, when you really could meet conditions, or it'd be probable that you're going to meet conditions and therefore be able to recognize. Just want to say again that there's differences of views here. That in practice, again, one more reason that disclosures are really important in this area. All right, so let me see what kind of questions we have. Not unsurprisingly, they're about the employee retention credit. Let's see if I can answer them.
The second one, Jeff, you kind of touched upon the last point that you were making.
Let me just read the question here and then just make sure I have, and then I'll go to the first question.
Yeah.
What are most considering when the condition has been met in order to recognize revenue? Is it determining the entity is eligible for the credit or actually filing for it to receive it? Yeah, I mean, as I said, there's different views. Some would say they're eligible for it, even if they haven't been awarded it. Again, it's not an entitlement, so there's difference of views there. Some would say you've applied for it by amending the 941, the payroll tax return. Some would wait for it to be awarded to actually receive notification. Different views there. And again, I'm not going to try to say that one is better than one view is better than another. Let me just see if I can answer this other question. If an entity claimed an employee retention credit and should not have and received the cash, does this fall under normal contingent loss rules? Again, others can certainly jump in here. I would think that if you've already recognized this and you've then find out that they're not eligible, and I know that this was the case I'd heard with the PPP in some instances, I would think then yes, you would have a loss contingency. You would have to accrue for the refund of this employee retention credit if you're not eligible for it. I didn't know if anyone else wanted to jump in on that.
I'm not sure you could really answer that quite as broadly of whether that's a loss contingency or whether, because I think we need more facts. And I'm not accusing anyone of motives, but we're certainly aware that fraud was relatively prevalent.
Got it.
In certain people requesting funds. I'm not saying that's the questioner's question, but I think you'd have to figure out, well, clearly if they were never entitled and that was clear, I'm not sure that treating that as a loss contingency versus questioning whether they should have ever recognized a gain. They may have had a liability from the outset. So you might be talking about restatement and impacts of fraud all the way to it was unclear and something in between, that is, maybe it wasn't fraudulent, but they never met the conditions. If they never met the conditions, it probably isn't a loss contingency. It's a question about whether it should ever been recognized. So I'd say if you're in this, there's probably a lot more facts to get before we could answer it.
Thanks, Jim. I knew you'd add some great perspective to my answer. Yeah, no, agree. A lot depends on the facts and circumstances. Possibly a loss contingency, possibly a restatement. Depends on the facts and circumstances here. Okay. Any other questions? Let's just say here before I turn it over to Nellie, who's going to start us off talking about the current agenda. Okay, if not, Nellie, it's all yours.
Great. So on our next slide here, on the slide after this, we have some highlights from our current technical agenda. We've got a lot going on at the FASB right now. So much of this has been or will be covered elsewhere in our webcast today. So for this slide, I'll highlight a couple things. First, I want to talk about the Eitf21a issue that was added to the agenda in September of last year. The objective of that project is to consider whether the proportional amortization method of accounting should be expanded to investments in tax credit structures beyond low-income housing tax credit or LIHTC investments. The proportional amortization method was developed in an EITF issue back in 2014, which gave 5 criteria that an investment in a LIHTC structure must meet in order to be able to apply the proportional amortization method of accounting, or PAM, as we fondly refer to it. But again, that EITF limited the application of PAM to these LIHTC structures. PAM results in the tax credit investment being amortized in proportion to the allocation of the tax credits in each period. And it allows the investment amortization and the tax credits to be presented on a net basis within the income tax line item. Generally, these types of investments, absent PAM, are accounted for using the equity method, in some cases the cost method, but under those methods, the investment gains and losses and tax credits would be gross in the income statement. The board had received 2 agenda requests asking that the proportional amortization method be made applicable to new market tax credit investment structures in particular, as well as some other investment structures when they are made primarily, or the structures that are made primarily for the purpose of receiving tax credits and other tax benefits. So the exposure draft of this EITF consensus was issued this summer. It did propose that investments, regardless of the program from which the tax credits are received, can be accounted for using PAM if certain conditions are met. Comments were due back on October 6th, and we expect the EITF to begin redeliberations of this issue at their meeting in December. The other project I wanted to highlight on this slide was the segments project. This one's been on the board's agenda for a little bit longer. It was actually added after the board's last agenda consultation prior to 2021. And we just issued the exposure draft for this in the first week of October. So the objective of this project was to improve segment disclosures and provide users with more decision useful information. And the exposure draft does this in a couple key ways. So first, the amendments require that a public entity disclose significant segment expenses. These are regularly provided to the CODM and included within each reported measure of segment profit or loss. The significant segment expenses are disclosed on an interim and an annual basis. And we call this the significant expense principle. So then the amendments are also required that other segment items are disclosed. These are basically a reconciling item between segment revenue minus those significant expenses and then minus that segment measure of segment profit or loss. The net there is what we call other segment items, and those are required to be disclosed. Third, the amendments require that public entities provide segment disclosures on an interim basis, which should get more consistent information about the segments. The amendments clarify that, so if a CODM uses more than one measure of a segment's profit or loss, at least one of the reported segment profit or loss measures, or the one measure, if just one is disclosed, should be the measure that is most consistent with the measurement principles used in measuring the corresponding amounts in the consolidated financial statements. So you have to report the measure that is most consistent with GAAP, and then you're not precluded from reporting additional measures of a segment's profit or loss that are used by the CODM. And then lastly, the amendments require that segments disclosures, both existing and in this exposure draft, are provided by a public entity that has a single reportable segment. Overall, this proposed ASU is the most significant change to the segment guidance since that guidance was issued. And we think that these amendments will provide investors with additional information about segments. We've heard that that's just absolutely critical to investors. And we really look forward to receiving feedback on this throughout the comment period. The comment period goes through December 20th, so you can get those right in before the holidays. Continuing on with our technical agenda on the next slide. This slide highlights our conceptual framework projects, our research agenda, and our post-implementation review projects. Our conceptual framework projects, if you're not familiar, that's a body of kind of interrelated objectives and fundamentals that give the board a foundation for setting standards and give the board some concepts to use as a tool for resolving accounting and reporting questions. As I mentioned, the concepts are a tool for the board. They are not authoritative. They don't change or create any existing gap. We have three projects left to complete all 8 chapters of Concept Statement 8. We should have proposed concept statements issued in the next month or two on reporting entity and recognition or derecognition. And then we'll complete measurement after that. And then we'll have a complete Concept Statement 8. We will come back to these research agenda items. We've already covered some of our post-implementation review projects. The one post-implementation review that didn't get covered specifically in the beginning is the revenue recognition post-implementation review. That one is also the closest to being completed, which makes sense because revenue was the first of these 3 standards to be issued in 2014, and it was effective for most calendar year public entities in 2018. And just while we're talking about PIR, I would highlight that the FASB is co-hosting and participating in a conference next month to discuss some of the academic research coming out of the post-implementation review process or related to our post-implementation review. So that includes topics related to revenue as well as topics related to leases and CECL. We're really looking forward to that. And then for revenue specifically, we have been providing the board with periodic updates on the staff's research and monitoring of the implementation of the revenue standard by stakeholders. And most recently, this included our meeting in September, where the staff provided an update on adoption of the standard by non-public entities and on a couple different research areas. This slide lists a couple recently issued ASUs. We have covered most of these individually, so I'm not going to add anything here to this slide. Continuing on, this is covering a bit about our agenda consultation initiative. You might be wondering what our agenda consultation initiative is, or to the extent you listen to FASB discussions or other similar webcasts, you might not be wondering what that is because we tend to talk about it quite a lot, especially recently. And speaking for myself, I think part of the reason that we've been so focused on this initiative lately and why we've spent so much time on it over the last year and a half or so, is that we're just very grateful for all the feedback we received, all the time and effort that our stakeholders put into responding to this, and very excited to continue to incorporate all of this good input into our process over the coming months and years. So really looking forward to that. Continuing on this slide about the timeline here, this one. So the agenda consultation invitation to comment document was issued in June of last year. In creating the ITC, we spoke to hundreds of different stakeholders to get their opinions on where we should or should not focus our energy or resources. The ITC document itself included several themes kind of organized into chapters to help get feedback on specific targeted areas. And then we did also ask general questions about prioritization, other things that stakeholders wanted us to focus on. And comments on the ITC were due back about a year ago, and we had our first public discussion of that feedback in December 2021. That was a starting point for over about 6 months and really continuing on a public discussion of all of the feedback we had received through that process. So that all was able to be brought to the board and discussed in public. Continuing on to the next slide. So here you will see some of the things that the board has either added or refined as a result of the feedback from the agenda consultation. Several of these will be discussed at various other points in our discussion today. So I will focus on just a few of them. First, I will highlight the accounting for environmental credit programs. The board added this project in May of this year. During the agenda consultation process and as part of that feedback, the board heard that for some programs and credits, there's diversity in practice in how these programs are being accounted for. That includes cap and trade type programs, baseline and allowance type programs, RECs, carbon offsets, all kinds of various things like that. So this project, the board decided that this will focus on improving the recognition, measurement, presentation, and disclosure for participants in both compliance and voluntary environmental credit programs, as well as the accounting for non-governmental creators of environmental credits. And the board did tentatively decide that the scope of this project does not include the accounting for tax credits, tax incentives, or investments in renewable energy structures, entities and partnerships and things that fall into that category, because generally there's other gap for those transactions. Excuse me. Next, I want to talk about, I'm going to go back to the previous slide briefly. Actually, I want to talk about two of these projects that we the board were able to sort of redefine or refocus here. First, the disaggregation of income statement expenses project. This had been on the board's agenda in some form or another for quite some time, but the feedback from the agenda consultation really helped the board be able to redefine this project, kind of establish a new scope and chart a path forward here. So most recently at meetings in July and then earlier this month, the board tentatively decided on a path that would focus on disaggregating specific items from all relevant captions on the income statement. The board discussed a few different aspects of that approach. We're going to do some outreach and kind of go from there. We heard very clearly during the agenda consultation process that investors wanted additional information about the income statement in particular, and we're really focused on charting an achievable path forward on this project. And then the other one here that we've noted as kind of redefined is targeted improvements to income tax disclosures. Again, this project has been on the board's agenda for quite some time. We had 2 previous exposure drafts in this project. And again, the board heard through the agenda consultation project that additional information to enable investors to understand risks and opportunities related to income taxes and just provide a little bit more detail there was very important. So the board has kind of tentatively decided at this point to focus on exploring 2 things. First, additional disaggregation of cash taxes paid, likely by jurisdiction. And then additional disaggregation within the rate reconciliation disclosure, either by itemizing specific items that need to be provided or by kind of setting a quantitative threshold or a combination of both of those approaches. The staff are currently conducting some outreach and research on those disclosures and what that might look like, and then we'll bring that back to discuss again with the board, hopefully here shortly. I'll pause and check and see if we have questions. I don't think we have any open questions right now, which is good because I have more to say on the agenda consultation, perhaps unsurprisingly. So continuing on to the next slide. This slide highlights some things we have removed from our agenda. So the board and the FASB staff don't have unlimited resources. So if we are going to prioritize some things, we need to deprioritize others. So I'm going to touch on a couple of these. First, I'm going to mention liabilities and equity phase 2. First, calling something phase 2 around here can be tricky. Often that means that the project relates to issues that the board and the staff couldn't figure out how to solve in an earlier phase. That's not always the case, but it was a kind of a challenging element here. The board had initially received feedback that the liabilities and equity guidance is challenging to apply. It's complex, it's spread across numerous codification topics, and it can be fairly rules-based and can sometimes result in conclusions based on form rather than substance. And we do continue to hear some of that feedback. In this project, we had proposed and researched different approaches. We had put one of those approaches in a proposed ASU. The project scope had been kind of narrowed to improving and aligning the existing indexation models. The board had kind of considered multiple different paths over time for how to make progress in this specific area. And more recently, the staff had conducted additional outreach with our stakeholders and heard that while stakeholders acknowledged the challenges with the model, they generally did not want to change the outcomes of applying the guidance as much, which can make it challenging to try and make improvements. And some stakeholders who indicated that improvements could be useful here expressed preferences for different ways of making those improvements, so it was hard to find a consensus. In addition, in all the agenda consultation feedback, this was not ranked as a particularly high priority for the board to take on, especially by investors. As such, the majority of the board decided to deprioritize this project and take it off the agenda at this time. I will say this was the majority of the board, not all of them. So some board members felt like this was an important area to continue to work on, and it may come back up in the future. Next, I want to talk briefly about the Goodwill Project. We have heard anecdotally that removing this project from the agenda was surprising to some stakeholders. So I'll walk through a little bit of that process and some of the board members, kind of the rationale that they explained in doing so. First, I think we all can acknowledge stakeholder feedback in this area is mixed. There's a wide variety of different views on whether Goodwill, recognized on the balance sheet, holds its value over time, whether it's a wasting asset, whether impairment is decision useful, whether amortization would be viewed as improvement, either by being less costly or providing better information. People have all kinds of different views on those issues. And in particular, in my opinion, there are different views within each specific stakeholder group. For example, investors are particularly mixed on this topic, and it can be challenging for the board to balance such disparate perspectives. And one piece of feedback that we additionally did observed was that some stakeholders were concerned about reducing convergence with IFRS. So this accounting is currently substantially the same, and this would have created a difference. The ISB is working on a project in this area on business combinations and goodwill. There's at the moment is more focus on disclosures. We will continue to monitor that project. Next, from a project perspective, the staff had been asking the board for their leanings, and the board and the staff had kind of expressed an interest in bringing back the full model to discuss with the board holistically after many of the tentative decisions had been reached, and that was what led to the meeting earlier this year. When reviewing that package of tentative decisions, the board members noted that they just didn't feel comfortable that the benefits of that package as it had been collected would outweigh the cost of making this change. So that was the impetus for deciding to remove it from the agenda at this time. And I will just say, with all of these projects, we often joke that we don't throw anything away. So when we remove a project from the agenda, that's a joke, but it's also true. So we are prepared if and when these topics come back up or the board decides to return to them, we will be able to pick back up. Don't know if there's any questions on that or if anything else to add there. Okay. Continuing on, this is the current state of our research agenda. Many of the items on this research agenda today had been added because of agenda consultation feedback. So I'll highlight a few of those items. First, we will talk about our project related to software in more detail in a few minutes, but we also have a research project to consider the accounting for intangibles kind of more generally. The board did hear that intangibles have increased their importance to the economy over the last few decades. It's more common to have companies whose sole focus is software or intangibles or where that's where a significant source of their value comes from. Overall, respondents wanted the board to perform research to kind of better understand the information needs of users as it relates to intangibles, and then also we heard some consideration of the costs and challenges associated with preparing that information. So this research project is going to focus on that area. Next, you may have noticed on a previous slide that the board had removed a project relating to consolidation. That project was trying to reorganize the guidance in topic 810 on consolidations. The board heard that project was not a priority. However, stakeholders did indicate that the board should consider or prioritize whether a single consolidation model could be developed for business entities that would apply to all entities. So without the separate models for variable interest entities and voting interest entities. This research project will explore whether we think that's feasible, and we don't expect work on this project to begin in earnest right away. Next, some respondents, in particular investors, stated that defining KPIs in GAAP could provide investors with a common starting point. This could include EBITDA or other widely used KPIs, and that possibly that could result in better comparability. It's still not exactly clear kind of how that would work or which KPIs would be most useful to define. And the risk of defining these things is that then management would continue to make adjustments, and then the definitions may or may not be a useful starting point. So this project is going to explore that. We did hear some interest in that, and we're going to do some research on whether we think there's a feasible path there. And the last one I will touch on briefly is the project regarding the statement of cash flows. Stakeholders did provide feedback that greater disaggregation and transparency of cash flows would be useful to better understand and analyze operating results for companies. So the staff's exploring potential disclosures, possible improvements, and other items related to the statement of cash flows through that research project. And then on our next slide, we've got, it's just critically important to all of us, that to the board and the staff, that stakeholders know how much we value the input that they provided through this process. Everyone took a lot of time and effort to give us their feedback. It's so helpful to us. We really have prioritized the transparency of how we're dispatching that feedback, how we're addressing that feedback, making sure that stakeholders can understand how the board considered what we all heard, how that translates into the pursuit of achievable standard setting. And as part of that, we issued the agenda consultation report this summer. Summarizes at a reasonably accessible level, faster than reading all of the individual comment letters, all the feedback we received, how it was addressed, what happened. It's a great document. We hope you check it out. And then it also includes charts that show the relative prioritization of different topics by different stakeholder groups. And in total, the prioritization in total as well. And you will note that in particular, the top investor priorities have all been reflected in our agenda so far. We're very proud of this. We hope to continue to make progress in these areas in the near term. I think that's everything on the agenda consultation. We did get a question about the direct method for the research project on the statement of cash flows. That is always a question. As currently written, the guidance kind of prioritizes the direct method, but it's not particularly well utilized in practice, according to our research. That is something that is a theoretical possibility. I don't know that there's a ton of interest in that at the moment. The other thing that the board has considered is whether some of the information that would be provided by the direct method of cash flows, some of the useful information could be provided as supplementary disclosures or provided in some other way. So we're looking at a broad possibility and a broad swath of possible improvements. And I would just highlight this project's on the research agenda for now. We've not added it to the agenda. The board haven't kind of established a path forward. So I would definitely say stay tuned there. Anything else anyone wants to add to any of this or any other questions there?
Over to me, Nellie.
Yes, I think so.
Okay. I see we have a question on this is with regard to ESG. It seems like everyone's trying to promulgate standards. How will all of the disclosures be coordinated? I would say one, as it relates to, I think the areas that we got input on from the agenda consultation, they were really more, I would call it sort of direct debit and credit related, sort of, ESG indexed financial instruments, impact of emissions trading schemes, where I think it would be the type of projects, whether you had a label ESG or not, people would be coming to the FASB and saying, hey, we see these kinds of transactions. We're looking for accounting and disclosure guidance. And so I think we'll certainly be cognizant of the activities more broadly, but I think at this point we're viewing our mission as really financial reporting and doesn't go beyond that. Let me turn to one of the projects that really was on our agenda pre-agenda consultation, and then I'll touch on a couple of the ones that Nellie mentioned in her remarks. But let me start with joint venture formation transactions. And if you turn to the next slide, this really came to us probably for multiple reasons. One, just a historical lack of guidance on how do I account for assets? What basis do I use for assets transferred and liabilities assumed in connection with the formation of a joint venture? If you go back several decades, there was probably a much stronger predisposition toward cost and a view that fair value could only be used in joint venture formation, sort of in limited or more unusual circumstances. And I would say those have probably changed due to a lack of authoritative guidance, changed over time through views of either SEC through speeches or accounting firms, and sort of non-authoritative guidance that really, I would say, shaped the landscape and how people view JV formation transactions, resulted in diversity in practice, perhaps sometimes very similar fact patterns. Some would say cost is required, and others would say cost is prohibited. So challenges in answering maybe just fundamental questions. And then part of it is also related to the board's conclusions on the venture parties accounting for the transaction. So if you contribute assets or contribute a business, the full step up in gain recognition associated with the joint venture party retaining an interest. I think decades ago that retained interest would have been in many cases at cost. The retained interest is now stepped up at fair value. And so if the JV formation itself is done at cost, results in basis difference between the venture parties and the JV itself. And then if you go through the application of the equity method, you think about what do I do with those basis differences? And you quickly get into all of the, I would call it sort of spreadsheet accounting for JV basis or equity method basis differences that could pose real challenges in terms of operability. So I think that's largely what drove the request. Now, the objective really is to reduce diversity in practice. I would add, provide clarity to practice by having actual guidance that would be applicable to JV formation, and then also through that provide better reporting to users of financial statements. If we turn to the next slide, just a quick illustration of the accounting question we're posing here. Pretty simple, I guess, in this formation, in that we're contributing by one party cash, another party is contributing PP&E that has a cost basis on the contributor's financial statements of 5 million, but a fair value of 10. So you've got each party contributing consideration that has a value of 10, each taking likely then a 50-50 interest in the JV. So the accounting question is, we know what to do with the cash. You got 10 million of it, pretty easy to book that entry. What basis do I bring that PP&E over at? Is it at its historical cost of 5 million, or is it at fair value? Obviously, the offsetting entry is the capital provided by the formation. Again, I think some diversity in practice, but certainly pretty straightforward example. Gets much more challenging when you're talking about the contribution of, let's say, two businesses to a JV. And you think about then all of the basis differences that could arise between the cost method of formation and the venture parties basis in the transaction. But even in this example, the venture party A is going to have a $10 million basis. It contributes 10. If you bring the PP&E over at 5, it's going to create a $2.5 million basis difference between its investment account and its equity in the JV. So again, just a quick example to illustrate the practice problem. If you turn to the next slide, I'll just walk through the conclusions or the tentative decisions of the board that will lead into the exposure draft. The first was really a question of should we do anything with respect to the definition of a joint venture itself. We're now providing guidance for the first time on how you treat the formation. And the conclusion of the board was no, that the issue that was brought to us was really what basis do I use? It wasn't should we redefine what a joint venture is. We're certainly aware that when we provide more prescriptive guidance, that can lead to questions about scope. And so I would say, if you're thinking through these issues and are challenged with scope questions, don't hesitate to raise those as part of your response to the ED. But I would focus really on the conclusions of the board. But we want to be aware whether something is in scope or not of the things that you or those who you're teaching CPE to are challenged with. The most fundamental decision of the board in this project is really the second box there, that joint ventures would recognize and measure assets acquired and liabilities assumed at fair value, consistent generally with the principles in topic 805 on business combinations. This would not, however, be treated, let's say that there were two businesses provided or contributed to the formation. It wouldn't be treated as the acquisition of one business by another, but it would really be looked at as if the new co or the vehicle that is the JV was acquiring those as a collective business and follow the 805 principles to fair value the entirety of the contributed assets and assumed liabilities. We clarified that the scope of this issue was really the contribution of all items, irrespective of whether they're monetary or non-monetary. Initially, there was some thought that perhaps we should just provide guidance on non-monetary assets contributed. I think we thought a much more holistic project in terms of providing clarity would address formations irrespective of the nature of the assets contributed or the liabilities assumed. The scope would, or the scope and the objective would eliminate many of the sources of basis difference between the venture party and the JV itself, but may not reduce to zero all of the potential reasons for a basis difference in those accounts. If you're aware of, or those commenting are aware of others that would be a significant impediment, again, I would say don't hesitate to provide those to us in your comment responses. And then it would also require a standard set of disclosures at formation, largely related to the nature of the transaction, the basis of the assets if it's not already evident, and I would say application of the 805 disclosure principles, really consistent, however, with a JV formation. So I don't think there'd be anything in there that would surprise you if you're familiar with the business combination disclosures. So those are the tentative decisions of the board. Won't go through the entire history here. We're really in that last box on this slide. With an exposure draft that says expected in October of 2022. So we've got a couple of weeks if we're going to hit that expectation. I know that the board's ballots were due already, so I assume we're in the final stages of the process, which is the production process. So I would expect it shortly. Although we don't have an exact date at this time. That's JV formations. Let me turn to one of the projects that was added as a result of our agenda consultation. And I would say, if you turn to the next slide, this was something that I would point out. We really got feedback, I guess, in two ways. One, on intangibles more broadly, as Nellie talked about, that, you know, our economy and the use of intangibles or their value for many entities has expanded over time. And so just a broad observation with respect to intangibles and whether we should have a look at the accounting for intangibles. But software was also an area in the agenda consultation where we got a lot of, I would say, more granular or specific feedback on the state of current software accounting, which does differ in some respects from the guidance on intangibles more broadly. And I'll talk about a few of those observations that we heard through the comment letter or through the agenda consultation process in a few slides. So based on that, the board had an educational meeting where the staff provided us some, I would call it state of play with respect to existing software accounting, some of the questions, some of the challenges, and the observations of those respondents to the agenda consultation, as well as input the staff had received through its own separate outreach. That did then result in the board adding an accounting and disclosure project for software costs in June of this year. So it's a relatively recent development. But it was a decision to add broadly the accounting for, I would call it, all software, whether those are internal costs or costs to acquire software. And we're currently in a phase where the staff has developed alternatives, is in conducting outreach with preparers, auditors, and users on the alternatives that we'll talk about in a slide or two here. So if you turn to the next slide, really illustrates at least part of the reason for the question or the concern about whether or not we ought to take a project on to look at software costs. And it fundamentally has to do, at least in part, with the fact that we have two accounting models for software costs. One for, I'll call it internal use software. That was really the focus of it. This is software that I either acquire or develop for my internal use and has a different set of accounting guidance and different capitalization guidance than external use software. Interestingly enough, internal use software also includes, in practice, software costs associated with hosted software. So this is, think software as a service. So I'm not licensing the software, and it's a hosting arrangement where the customer can't take possession of the underlying IP. So notwithstanding the fact that the software might be monetized through third parties, it falls into an internal use software category. That model also applies to the cost to implement cloud computing solutions. On the other hand, we have separate, different, distinct guidance on the cost for software to be sold or licensed. Observation by many that these categories certainly have been blurred by developments in how software has been delivered over the last decade or so. That is, when these standards were written, I think a very clear distinction: you either licensed software or you developed yourself. It wasn't really a world in which we saw software as a service, and that's a pretty fine distinction if you think about the last bullet on the software license, that it could be a cloud arrangement, but you would get different accounting for the development cost depending on whether your customer could take possession of the underlying IP or not. Certainly a question of, do you really have a different asset, or should you have a different asset model simply because of the form of delivery? So a lot of questions there. And then on the next slide, I think also in addition to some of the problems or developments in software that resulted in some diversity in practice and potentially outcomes that are not necessarily intuitive, we also heard that the way software is developed is significantly different today than it was the 2 or 3 decades ago when these pieces of literature were written. At the time, software followed much more of a waterfall model. There were very distinct and clear paths of progression in software development. In today's world, software is developed in an agile framework that the different modes or components of software development that existed in the 80s and 90s really isn't the manner in which software is developed today. And so the guidance, some of the guidance that we have doesn't even really fit particularly well with how it's described in the literature. All of which really led to a broader call on the next slide that we heard in the agenda consultation process to comprehensively look at recognition, measurement, presentation of disclosure, the objective of which is to modernize the accounting for software, but also to enhance the transparency around those software costs. That is the project that the board added to the agenda. And on the next slide, we'll talk a little bit about some of the paths or the potential paths forward that the staff is researching. And in the context of the board's objective in adding this project, that we really didn't want to have a split model. That is, we thought there ought to be one model for the accounting for software costs. So the first path that we're exploring would be to require software costs to be capitalized based on a principle, such as when you have a present right to an economic benefit that resulted from those costs. We're certainly exploring that if we did have that principle, what type of operational guidance would we either need or want to provide in connection with operationalizing that principle. The second model is looking at requiring the capitalization of all costs, but tie those costs to certain development activities, or should it be activity-based? And then the final path that we're looking at is whether or not we should move to a model that would expense all software costs as incurred. Differing board members probably have different perspectives as where they might start on these alternatives. For example, I would personally challenge whether expensing all software costs would be responsive to the agenda consultation feedback that challenged whether or not we ought to have more intangibles on the balance sheet. And I'm not sure that people would find it particularly intuitive, particularly as it relates to purchased software. So again, we're exploring one model. I think you might find a little bit of pushback if we were to say, hey, you just licensed an X $million investment in SAP, but go ahead and expense that asset that you just acquired. But I do understand how that could be operationally easier to apply that model as it relates to internal development. So those are some things I think we'll have to work through. So that is the input that we've received to date. Next steps, as I said, the staff is conducting research that they will bring back to the board. We're exploring the operationality, the availability of data, and particularly the usefulness to investors. And we're doing it across a wide range of industries, not just those that are software-based entities, but also the purchasers and consumers of software. And with that, let me turn to one of the other areas that we receive feedback on in the agenda, consultation, I think with the most degree of prevalence, and that is the accounting for and disclosure of crypto assets. Not going to be a surprise to anybody who reads the accounting press that this has been added to our agenda. And it's also not a surprise to anyone on, I think, the reasons why crypto items or crypto assets, when you weave your way through the accounting literature, if they don't meet the definition of a security for accounting purposes, probably weave themselves all the way into an accounting for intangible model. Accounting for acquired intangibles, as everyone knows, is a model that is a cost-based model subject to impairment. To make those challenges worse, those impairment tests are done at a low water mark, so not just at quarter end, imposing challenges and questions about why am I writing my crypto down only to the low water mark, never to recover that until sale. And so questions about the accounting certainly also posed challenges with respect to then non-GAAP practices and whether entities could or should be able to be permitted to back out those impairment losses. It does seem like they're economic losses, but then that causes questions about why am I recording only losses and not gains? And then finally, an observation that we already do have entities that find themselves into a fair value accounting model through crypto when they're in specialized industries such as investment companies and broker dealers. So if you turn to the next slide, I think I already touched on the accounting doesn't really reflect the economics of crypto today. We're booking losses, but not booking gains until realized. The impairment model comes with its own set of challenges. It results in a mismatch for those that are engaged in crypto lending. So I have the asset, I go through a lending transaction and conclude that I can't de-recognize the asset, but have a liability that might be recorded at fair value. So now I've got a mismatch between the asset and the liability, probably really driven by the first box, that is the accounting for the asset didn't recognize the underlying economics. So I'd say a lot of reasons why people raise this as a potential issue for us to address. And if you turn to the next slide, the board has added it to its agenda, has reached some conclusions previously in August on the scope of what we're thinking about as crypto, which is probably one of the most important aspects of the project, because I think the measurement conclusions probably won't surprise people. But we are looking at a scope of items that meet the master glossary definition of an intangible. So if you meet the accounting definition of a security or a financial instrument, you probably already got a path and are accounting for the item at fair value. So we're talking about crypto items that are intangible. We're looking for crypto items in our scope where the holder doesn't have an enforceable right to underlying goods, services, or other assets. If you do, you probably got to think about, am I already in some type of accounting model where I have a contract that gives me rights to goods? I'm probably in RevRec. We have a scope that would say these items ought to be reside on a distributed ledger or blockchain and are secured through cryptography. That's really just reflective, I think, of current technology. So I think that certainly on each of these we'll have questions. Those probably seem more descriptive versus fundamental to the accounting outcome. So I'll particularly be interested in, should we be more flexible about how the blockchain is developed and does it need to be secured through cryptography or not? And then the final one is that the items are fungible. And that really did seem key to a conclusion. If we're going to move to a fair value measurement, that we ought to be talking about things that aren't unique or individual assets, such as the potentially in a non-fungible token, but we're really talking about those things that are unit interchangeable. So that's the tentative scope that the board reached. And then in a meeting last week, we concluded that the measurement would be a fair value measurement. It's not elective, it's not optional. And Nellie, unless I'm wrong, we didn't provide any other exceptions to fair value. I think I would call it sort of a straight up follow 820. So that's crypto.
All right, thanks, Jim. We didn't get any questions on any of those topics. I think we can move right along. So the next project we're going to talk about it's a PCC's research project on profits interest. And so in October of 2018, just to give some history on the project, BDO submitted an agenda request for determining the appropriate scope of the guidance for profits interest and similar awards. The agenda request identified key differences between the accounting models in topics 710 and 718 and identified challenges in practice in determining which of those topics to apply to profits interest awards. The agenda request noted that some in practice have taken a facts and circumstances based approach in which they asserted that has created diversity in how entities determine the appropriate guidance to apply. And therefore, given the judgmental nature of the analysis, different entities have similar awards with similar features may come to different conclusions, and the profits interest arrangement may be accounted for differently. Moving forward to August 2020, the PCC formed a working group to assist the FASB staff with outreach, identify practice issues, and identify potential solutions. Since then, the staff and the working group have performed outreach with a wide variety of stakeholder groups to better understand the issues that are associated with the profits interests. The effort has included outreach to better understand taxation and valuation of profits interest and identifying accounting issues associated with profits interests. And so at its April 2022 meeting, the PCC members noted that the diversity in practice and cost and complexity result from the lack of authoritative guidance that explicitly addresses this profits interest. So the PCC recommended that the FASB add a project on profits interests to specifically address the scope issue because the issue potentially affects both public business entities and private companies. So currently the PCC is assisting the FASB staff in the development of solutions. And more recently at its June and September meeting, the FASB staff discussed with the PCC potential illustrative examples and transition guidance if the board were to add a project to its agenda. So just moving on to the next slide, I'm just going to go over some key features of a profits interest. For starters, the term profits interest is not defined within the FASB codification. However, it is defined for federal tax purposes in Revenue Procedure 9327. Profits interest are an interest in a partnership's future profits and or equity appreciation and can be economically similar to stock options or stock appreciation rights. However, the provisions vary in each partnership. The outreach conducted has found that profits interest awards are often granted to executives of private equity portfolio companies, and typically entities are incentivized to design profits interest to defer taxation. Moving on to the next slide. So when evaluating how to account for a profits interest award, an important determination is whether an award of profits interest represents a deferred compensation arrangement, such as a bonus or profit sharing arrangement within the scope of subtopic 71010, which is compensation general, or a share-based payment arrangement within the scope of topic 718, which is stock compensation. There is no explicit profits interest guidance within GAAP on how to determine whether compensatory profits interest should be accounted for in accordance with subtopic 71010 or topic 718. Although not listed on the slide, some firm publications also reference topic 450 contingencies. So just moving on to some of the outreach that we've done. As a result of the outreach conducted by the staff and the working group, we learned that profits interests are usually accounted for under topic 718 as stock compensation, and that there are mixed views on how difficult it is to determine the appropriate scope and practice. In the outreach calls, the staff observed diversity in practice amongst firms, such as differences in the treatment between larger and smaller practitioners, and noted that there is significant dependence on non-authoritative guidance, including the guidance published by public accounting firms. Although the feedback was mixed, most stakeholders supported adding a project to the technical agenda to address the scope issue and pointed to implementation guidance and examples as a potential solution if a project's added. And so in terms of next steps, the PCC and FASB staff will work to develop solutions to address the profits interest scope issue, including developing illustrative examples of how the existing scope guidance in topic 718 would apply to common profits interest awards. And in the future, the FASB will discuss a potential project during a board meeting. I'm not seeing any questions on that, so I think we can move on to the last topic here, which is reference rate reform. So the objective of the project is to defer the sunset date of the relief in topics 848 reference rate reform and amend the definition of the secured overnight financing rate, which we call SOFR. And so we've talked a lot in this in the past forums on this project. So I'm just going to give you a brief update, which is that the board met recently and affirmed that the sunset date of the guidance in topic 848 will be extended to December 31st, 2024. And the amendments in the final update will be effective immediately for all entities upon issuance and applied prospectively. The board decided not to amend the addition of SOFR OIS rate, and the final guidance is expected to be issued during the fourth quarter of this year. So with that, let me just see if there's any questions on this. And I'm not seeing any questions, and we are right on time. How's that for timing? So I just want to thank everybody again for your participation and for your interest and the questions. As always, feel free to reach out to me. I can on any of the projects. If you have questions, I can always direct you to the right staff. And also, just lastly, be on the lookout for the survey, and this will be also archived for 6 months on the website. So with that, just thank you, and I'll have everyone have a great day.